Adrian Day of Adrian Day Asset Management joins me now at the San Francisco Hard Asset Show. Adrian, thanks for being with me.
Well, thank you.
So you're a presenter here at the show once again.
Yes.
What have you come to tell the audience this time around?
Well, not surprisingly, I've come to tell the people it's still time to buy gold.
Right.
I think gold is the one asset really that was the beneficiary, other than bonds. Gold is the one asset that was the beneficiary from the U.S. election results we just had.
Right. So we spoke prior to the election, about a week before. Election has come around, it's finished. Has everything gone according to plan for you?
Well, I guess you could say that. I mean, I don't know if you remember, we were saying that sometimes, if you're a conservative gold bug, you've got to be careful what you wish for, because one thing's good for the country and the economy, and the other thing's good for your portfolio. But to be serious, yes, I mean, the re-election of Obama removes the threat, which I think was exaggerated, but the threat that Bernanke would go anytime soon and change economic policy, a monetary policy. Let's face it, there's no Volcker coming in anytime soon, going to raise interest rates to 20%. But the re-election of Obama ensures that Bernanke and his ilk stay in control of the Fed, and we continue to pursue, in my mind, a very misguided easy money policy. So extremely easy money and low interest rates, artificially low interest rates, which are now negative in the US as well as most major OECD countries. That's all positive for gold. At the same time, the fact that the Congress was split, the Republicans retain control of the House, Senate's still in control of the Democrats, means that we're going to continue the wrangling over the so-called fiscal cliff, particularly over taxes, but also, frankly, over spending cuts. And that wrangling is also good for gold. Think back to the last time we had these negotiations up to the last minute, 18 months ago over the debt ceiling being raised. S&P cut the U.S. credit rating. Gold zoomed. And I think we have the potential for a similar situation now.
So when you say zooming, what numbers are you looking at? Is that a 2,000 threshold or even higher?
Oh, I had to put numbers on it. One would have to think that congressmen have learned their lesson. So even though they're clearly not going to come to any kind of meaningful agreement, one hopes that they're not going to provoke the headlines that will force Moody's or Fitch to downgrade the U.S.
Right.
One hopes they've learned their lesson. But I think we could easily see gold over 2,000 in the first quarter. Is that a good enough prediction? I hate putting an exact number on it.
Right.
But number one is going higher, and number two, 2,000 is a reasonable number for the first quarter.
Okay, I'm going to call you the first quarter, Adrian,
Okay.
but let me ask you this. Some analysts I spoke to said, QE3, when QE3 came around, a lot of people were expecting that to really propel gold, and they're saying it really didn't. So now there's talk of a QE4. Do you agree with that?
No, I don't agree with that. Let's think. Every time there's a stimulus program or anything, frankly, if it's already telegraphed in the market starts to react to that ahead of time. And we talked about this in September, if you remember. Gold moved up from the beginning of August. Gold was moving up, and then towards the end of August, gold was already moving up quite strongly ahead of a QE3 announcement. But it was moving up strongly because it expected QE3.
Okay.
So if you look at what we might call the QE3 effect for gold, it was a good move from the beginning of August to the end of September.
So, Adrian, what do you say to those who say, well, for example, the issues in Europe, problems in China, QE3, possibility of QE4 have already been kind of baked into the equation?
Well, of course, problems in China and the economy in the U.S. is negative for gold. If the Chinese economy continues to decline, that would be negative for gold. So I'm more sanguine on China than a lot of people, as you know. I mean, we've got over 6%, maybe 7% GDP growth, and we've got inflation under 2%. We've got continued modest stimulus from China. I mean, I'm not concerned about China in the near term. Certainly Europe is a negative for gold because recessions are negative for gold. But it looks to me as though QE3 is going to continue for a long time. I mean, some people have called it Q eternity because there is no time limit on it, right? They put no time limit on it. Come the end of the year, and remember, they're buying $40 billion worth of bonds a month, but they're also rolling over the bonds from QE2 that are expiring. So we've got $80 million of new bond buying coming into the market. We've also got, you know, the Twist program at the end of the year. They're probably going to extend that.
Okay. Well, you know I'll be calling you in 6 months, Adrian.
I know you will.
Thank you so much.
Well, thank you. Thank you.
And thanks for watching our coverage from the San Francisco Hard Asset Show. We'll have more for you. In the meantime, you can email me at newsfeedback@kitco.com or tweet me at Daniela Cambone. Thanks for watching.